Welcome. My name is Owen Woolcock. I'm a founding partner at Climate Core Capital. We are an investment firm focused on climate-oriented real estate. Today's webinar is about sharing a new perspective. A 3-year journey deep in data has left us worried about the future for large and small investors. And today is about sharing our mental model, laying out the data that led us to this point, and explaining the Climate Core perspective, which is the firm we started to address this challenge. Now, if you're attending a webinar with this title, the chances are you are understanding to some degree that the climate is changing, and you either want to understand this better or care about how climate change shapes our economy and the way we invest. We start with this image because it's a point of reference we can all identify with. Flying into a city at night, staring out the window, following the lights and marveling in some way at the scale of things that we've built. The most basic fact no one ever told you is that none of these lights are an accident. A predictable climate allows you to plan, and planning is the basis of civilization. Every large glowing light on this map started as a small scatter of huts and wood buildings near a water source with no guarantee of success. More people came, more things could be bought and sold, and over time plans were made to expand the streets, erect a town hall or a fire station, build railroads and motorways, and points of connectivity to other places. This is so obvious that you shouldn't feel silly for never giving it a thought in your life. But without the regularity of seasons, confidence in crops, fresh water flows through rivers from snowmelt in spring, our ancestors wouldn't have persisted in each of these locations. Now we're in a new phase. We don't tend to strike out and find new towns often. We simply add more fixed infrastructure to the places already established. The hypergrowth of our cities is why the lights overpower so much of the landscape from above, but this is also why we have a big problem. For decades, scientists warned of rising temperatures, more frequent extreme weather, and the possibility of entering an unpredictable or even unstable climate because of how our planet responds to carbon emissions. This looming forecast, which we've heard from since the 1980s, had a simple though not easy solution: reduce the amount of greenhouse gases we emit into the atmosphere. Now, our efforts to reduce those emissions haven't matched the urgency of those forecasts, and the impacts of global warming have now arrived. Once upon a time, we might have only needed to mitigate. Unfortunately, now we need to mitigate and adapt. To understand how we might adapt, we want to go deep into some locations and articulate that change for our audience and investors. Today's webinar looks at 2 markets that have enjoyed extraordinary growth since the year 2000. Phoenix's population has risen 22.1% since the start of the century, and Naples' real estate doubled in value during the pandemic. In different ways, they embody America's internal migration story in our lifetime. Different generations, but predominantly boomers, have been escaping colder, high-tax states in the northern latitudes and seeking warmth, lower taxes, and a different pace of life in retirement. All the signs would point to both of these markets enjoying strong fundamentals and a bright future. Let's begin with Naples, and specifically look at one of the easiest climate-related disruptions that each of us could foresee: a hurricane hitting a major real estate market in Florida. I want to consider this story in stages. So let's imagine a hurricane hitting Naples on a Sunday afternoon. On the Wednesday night or Thursday morning prior, the Weather Services gives notice of a tropical depression in the Gulf, with warnings of a 16-foot storm surge along the southwest section of Florida, where Naples sits. That's a big number, and many would consider leaving. The problem is the forecast could get better, or it could get worse, or the path of the hurricane could move altogether. What doesn't change is the 3.5 days typically needed in American cities to execute a mandatory evacuation order. It's not as simple as the mayor calling a press conference and telling everyone to leave. Airports need to close. Highways need to divert traffic so more vehicles can leave. And those without vehicles need to have services provided and arrangements made for where they go. Now it's Friday, around lunchtime, and the worst fears are confirmed. The storm has been upgraded to a Category 3 or Category 4 hurricane. We know this number from a news perspective, but what it means in practical terms is 110 to 155 mile-an-hour winds, or 175 to 250 kilometers an hour. Trees will be lifted into the air, mobile homes will be completely destroyed, and pets and livestock are simply unable to hold themselves to the ground. By this point, on the Friday, many more people choose to leave, but it's likely a mandatory evacuation has not been declared. They're not common in American cities. And so now, Naples needs to manage large numbers of vulnerable people and decide who should be cleared from hospitals. Now it's Sunday afternoon. The hurricane hits, and afterwards damages are assessed to be $95 billion. Power outages persist for 3 weeks, and 4 months on, it still is not safe for many people to return to their homes. Now, this chain of events might sound overly dramatic. If so, the unfortunate news is that what I've just described is the timeline for Hurricane Ida last summer. The only difference is the trajectory and path of the storm. Nearly 200,000 residential properties with an estimated replacement value of $44.5 billion sit in the Naples metro area and are exposed to the potential flooding damage from a storm surge like what I've just described. And nearly 385,000 local homes are at risk of wind damage in the event of a hurricane like this. This builds to an important idea in our language, which is disaster risk. All physical climate risk really falls into 2 buckets, and this distinction between disaster risk and slow onset risk is crucial. When we describe disaster risk, we mean extreme events that give little notice and cause enormous disruption and dislocation. They could be wildfires or flooding or violent storms or hurricanes. Some people in the audience might have lived through a disaster, but if you haven't, there's no guarantee that normal services resume at any point in time. The government response, though well-intended, is never that efficient, and there is no rhyme or reason to the path of damage or the features of infrastructure in a city that will fail. So what might happen next? Well, let's think about it in a sequence, and let's put ourselves in the perspectives of a landlord, a tenant, and the tax base. For the landlords, you are often looking at a complex federal aid process that is difficult to coordinate, there's a lot of paperwork, and there could be a long period of time where code requirements are getting updated and it's very unclear whether in-kind repairs are going to be sufficient. In other words, we're talking about a multi-year recovery. For tenants, low to medium income retirees often file damage claims because they are uninsured, and many tenants of every price bracket will seek to negotiate rent holidays during works, and some will just relocate to alternate markets. Then there's the municipality, who all of a sudden is facing a very different set of needs and a very different set of capabilities as to how they can respond for the needs of their taxpayers. The other crucial part is that their bond ratings will suffer, and the cost of debt for them to borrow rises because the muni bond investors are looking at a landscape of those very ratepayers being reluctant to pay higher and higher taxes for the recovery. Disasters change locations, and it's worth asking, if you live or own in these places, are you being adequately paid for your risk? Our second deep dive looks at Phoenix, Arizona. It's important we stress Phoenix is not unique or some outlier of the southern and southwestern United States. Really, what we're about to describe is something you should expect in many parts of the Sun Belt. What are the drivers? Well, this is what we refer to as slow onset risk. What do we mean by this? Well, just as a disaster has a clear before and after signal, slow onset risk has none of this. It's exactly how it sounds. It's gradual, it's a story of increments, it's small numbers in isolation becoming very grave over time. Today we're talking about 2 interesting parts of the Phoenix story: water scarcity and extreme heat. But it's important to keep in mind as we tell this story, there is no reason why the same features might not exist for sea level rise, loss of biodiversity, or longer lasting droughts. If you live in the Western United States, you are likely showering in or drinking water that originated from snow, as snowmelt actually makes up 75% of the region's water supply. Now, these are excellent diagrams and forecasts put together by Spencer and Allison and the team at Probable Futures and the Woodwell Climate Research Centre. And they show a story that really spans half of the continent. A warmer world reduces the number of days where freezing temperatures are possible. This affects the ability for snow to build up, which affects water supply, which affects the hard infrastructure we've built to capture and divert water, which is the case through much of the Western United States. It also affects what can be grown, because many plants and foods we rely on need that shock of big temperature drops and cold nights. Now, as the change shows between the 0.5 degree world on the screen, which is effectively what we describe for the 1970 to 2000 period, and the 2 degrees world, which is this slide and what we're heading towards, the amount of the Western United States that sees freezing temperatures is going to shrink significantly. But let's go back again and compare the 2 pictures. There is a difference, and it is major, but it's very difficult for investors to begin to frame this challenge or convert a map like this into actionable decisions. It can be done, It's just not intuitive for all of us. Now for Phoenix, as well as water scarcity, we want to focus on the temperature, and specifically the growing prevalence of extreme heat days in a calendar year. Prior to 2020, the record for the number of 110 degree Fahrenheit days in Phoenix was 33. In 2020, they shattered that record with 53 days above that threshold in the year. So let's imagine in the mid-2020s, there is another heat wave that produces a freak summer beyond this record, 65 days above 110 degrees Fahrenheit. Let's also imagine that through the year, there is 150 days above 95 degrees. That last number will sound shocking, but actually, it's exactly what is forecast for the middle of next decade on many interannual averages. So again, what does slow onset extreme heat mean for the landlord, the tenant, and the tax base? Again, the landlord is going to have to deal with building changes that are needed for slow onset just as much as disaster. For the tenant, it's not just the shock of the future, it's the growth story that Phoenix is coming from and what they have become accustomed to. 10 years ago, it was less than $1,000 a month to rent in Phoenix. That number has jumped 2x in a decade. But all of a sudden, you might start to see low and medium stock come under a lot of different public health pressures, a lot of different ventilation pressures. There might not be the willingness on the part of landlords to make the necessary improvements. So you're either looking at tenants that negotiate discounts, or you are facing lower inbound demand from retirees, workers, and students because the place-based features of Phoenix as an overall market start to become very different. As for the tax base, they again are left dealing with greater needs to a smaller population. Now, all of this can sound complex with maps and data, so let's just reduce it to the plain English with 4 simple examples to show that the tipping points are actually a lot closer than we imagine. Lake Mead is America's largest reservoir, but it is 150 feet of greater water loss and evaporation from 25 million Americans losing access to the Colorado River. A storm in 1955 hit the New Jersey coastline known as the Ash Wednesday Storm. There was $1 billion of footprint damage for the real estate at the time. It would be $100 billion today if the same storm hit. FEMA, who has been recording flood maps for 5 or 6 decades, it has now been shown has been drastically underestimating the level of risk and the number of properties that sit within the 100-year floodplain. And finally, on heat, Orlando, Houston, Miami, Austin, and Tampa will all record the same number of 95 degrees days as Death Valley by the end of this decade, the 2020s. And this leads into the framework of the webinar and why we think it's so important to analyze this challenge through a mental model and a theory of change. What do we mean by these phrases? Well, a mental model simplifies complexity. Climate Corps' mental model is about real estate investors accepting the future won't be like the past and building in capacity for adjustment. A theory of change is a description of why a particular way of working will be effective in the future. Climate Corps' theory of change is built on the premise of rolling cycles of change, and crucially that a unique window of risk-free transfer exists right now. Now, this diagram is one of the single most important breakthroughs we made in our data work at Climate Corps, so we're going to spend a few moments with it up on the screen. I want to pay tribute to Evan Kodra and the team at Risk, who was one of our early climate partners, and they developed a very simple scale from 0 to 5, with each census tract in the United States having its own score. The power of the original risk scale was that for every integer increase, so if you look on the bottom scale and just jump from 1 to 2 or 2 to 3, that was effectively correlating to a doubling of overall climate risk. Another way to think of that is if you multiply 2 to the power of 5, which is 32, there is an almost 32x greater risk of climate disruption in the location sitting at 4.9 on this scale compared to the location at 0.1. This was an important early insight for us, and so we built following this scale, matched our other climate data to it, and then asked ourselves, could we measure the ways a real estate market can exhibit climate readiness as well as climate risk? When we blended and weighted risk and readiness together over the same numerical scale, this was our shocking insight about many of America's most popular real estate markets. I'm now going to hand it over to my colleague Raj, who's going to talk us through some of the real estate implications of what we found in the data.
Thank you, Owen. My name is Rajiv Ranade. I'm a founding partner here at Climate Corps. I want to bring your attention to a few things on this graph. As Owen mentioned, it's a key framework for how we think about market selection in the United States. First is in the bottom left. So you'll see two boxes, one within dashes. That actually represents the median mark, the 0.8 score, which reflects actually 50% of American real estate, which means that 50% of American real estate is within that box and is actually below the median, and obviously the other 50% outside of it. But that 0.8 score reflects actually that much of America is in sort of a nuisance level of climate risk. But there are markets outside that, which are, of course, at risk and getting riskier. The second box is the shaded green box. This is really where Climate Core plays. These are the highest readiness, lowest risk markets in the country. That is where we believe capital can thrive alongside recurring climate risk. The final thing I want to point out is actually at the riskier end of the spectrum. In and around Naples, Florida, you'll see some larger dots that represents large areas of population. Some of those actually represent the top 5 growth markets from a residential real estate perspective in the country over the last 5 years. What that reflects is essentially that America is moving into locations of higher risk with both people and capital, which represents a compounding challenge. A question we regularly receive when sharing this story, particularly with investors in a first meeting, is why should I consider climate risk now? Isn't this an issue for decades from now? The short answer is no, and there are a few key reasons why. First of all, the repricing is already underway. Unfortunately, there's no line item for climate risk in investment modeling. Repricing is a function of different levers being pulled, and more often than not, multiple being pulled in tandem. That's impacts on OPEX, CAPEX, cost and availability of debt, insurance premiums, and taxes. As a key example of that, there's research demonstrating that Atlantic and Gulf Coast regional banks with local knowledge of their risk exposure have been syndicating and securitizing climate-vulnerable mortgages to Fannie and Freddie. The second is that the threat to capital is not constant or linear. It's accelerating and, importantly, at an unknown rate. A very relevant example this week actually is the probability of line tripping in an electrical grid goes from 15 to 100% if heat wave demand rises above 160% of nominal capacity. This week, that will happen in Texas. That happened 4 weeks ago in Texas. In both instances, heat waves above 100 degrees are sort of tragic events that end up creating this acceleration and are a reflection of it. The final and most important point is that de-risking today to climate risk off is free. The market has not priced in location-based climate risk, and to put it another way, today you can reduce risk without a premium. We think investors are better off allocating into climate risk off assets today in order to mitigate the challenges of divestment and rebalancing away from climate-exposed assets tomorrow, when it will be certainly much more expensive to do so. Everything we've covered to this point is really about our perspective and thesis, but how are we actually doing this? As we've said, we're an investment management firm focused on growing our clients' capital without exposure to climate risk. Our process is to identify so-called climate core investments in a 5-stage process. So to describe that process a little bit, a first point is that we are an allocator, identifying operators and developers in our key markets who can execute on the ground, and identifying the ones with institutional grade capability and track records that are demonstrable. The second is the market, to that green shaded box point, is the market in the bottom quartile of climate risk and the top quartile of climate readiness? And then third is the asset within a sub-market that represents within market climate beta, meaning is the sub-market lower climate risk than the overall market it's within. Fourth, is there low climate risk at the site level, at the exact street corners? And are there features of the building that demonstrate sustainable action or resilience in the face of climate risk? And then finally, and obviously most importantly, absent the climate, is it a fundamentally compelling real estate deal? Do the numbers work out? What has that yielded so far in our track record? So to date, we've done about $250 million of total GAV of climate-oriented real estate. Our current pipeline is about $250 million of equity. That's all focused on the residential space, typically in development, which represents 70% of our pipeline, and about 30% is more in the core plus yielding spectrum. Again, we're targeting a 17% IRR. This is not a low growth story. This is about targeting markets of high demographic, high economic growth that also mitigate climate risk.
Our details are on the slide, and we'd be delighted to spend our remaining time here in Q&A talking specifics. There are many other areas of our work that investors have shown interest in, and they have wanted us to speak about in public more. That can be deep dives on specific low-risk, high-risk markets, thinking about debt, insurance, and property taxes, as Raj mentioned, or even talking more about what we do with climate-oriented technologies at the building level. But we're conscious that there are a lot of new ideas in what we've put in today's webinar, and much of this is so new for many investors. The best way is just to begin the conversation, laying out the mental model as we've done today, and really just educating people as we learn ourselves. I think if you take nothing else away from today's webinar, we hope we've made it clear that we are entering a new phase, and everyone's investment decisions should incorporate a much wider range of outcomes than prior climate stability conditioned us to imagine. This is a big, hard idea for real estate investors to come to grips with, and there is going to be winners and losers in the coming cycles, both personally and at the portfolio level. We look forward to delving into some questions, and we're really interested to see what people would like to cover.
All right, our first question, why is real estate a sensible investment at all in climate change? A good question. We're often asked, real estate is a fixed asset. Aren't they most at risk in a changing climate? Ultimately, I'll talk a little bit here. People need to live and work somewhere, and the need for humans to have shelter alongside climate risk and adapt. We think real estate is a core part of that. There are elements of financial markets and asset classes that you can shift that can be mitigated kind of independently from climate risk. Real estate's not one of them, so. We think the opportunity to acquire real estate in places of low climate risk makes it a more compelling proposition, actually, as an asset class selection.
Yeah, an interesting question here on what's a typical climate core asset. So, as Raj mentioned, we have a development and core plus split. The typical core plus story will be a post-2000 building vintage where it's basically been built to a high inner city green building code to some degree. But then since the vintage of the building, there has been a number of climate-oriented building technologies that have become commercially viable that can almost be quick wins retrofitted to the building and potentially boost some of the NOI. In terms of development, that's a really exciting part of what we do because it lets us start with a blank canvas. It lets us think about the types of buildings that are still going to have a premium and be interested in holds 20, 30 years from now, being able to mitigate all the different site-specific risks that some markets will have to contend with. But I think the thing to keep in mind is we're very conscious about the fact that we are seeing a sea change. LEED is becoming a much more common indicator. Aspects of the brand will dilute over time because the points ranking system inevitably incorporates many more things, and there will be less of a premium on certified silver, gold. We take an interest in passive house design. It's not appropriate everywhere and in every climate region, but there's some fantastic features around that design standard, around tightening the building envelope, thinking differently about stabilized temperatures, air quality, lower OPEX over time that we think are going to be a much more common story among the investment community. But at the same time, we are planning to build a portfolio with a lot of diversity, addressing needs in different climates and regions. And so it can be difficult to nail down exactly what a climate core asset is at this early stage.
I think the one thing I'd add is we are very focused on the residential real estate sectors as a criteria of a climate core asset. Fundamentally, there is a secular trend, obviously, in this country around multifamily shortage, housing shortage. It's a secular trend you can play in our markets independent of climate risk. Because we play in climate risk, of course, it allows us to be in a single sector, whether that's multifamily, more horizontal build to rent, single family, on occasion student, in order to be very committed to the climate thesis within one sector.
We've also just gotten a question, are you firmly against investing in the Sunbelt? This is a great question. So a corollary of the data story I laid out might be that people assume as there has been this large move to the southern latitudes, as climate risk becomes more tangible and is priced into assets, there will be just a move back to the northern latitudes. We don't think it's going to be that binary a story. And an interesting thing we've found in the data is what we refer to as receiver communities. So these can be markets, large metro markets, where they are actually close to areas of very high exposure. They have some risk themselves, but much lower risk than the places that people might be leaving. An example of this is after Hurricane Katrina in New Orleans, the largest catchment of evacuees was Houston. Now, intuitively, why would people choose their largest neighboring market? Well, they have a skill set. They have something that they want to receive a certain remuneration for. So it makes sense to go into the largest labor pool closest to you to ensure that the greatest availability of jobs and new opportunities might exist. So we would, in that scenario, describe Houston as a receiver community to New Orleans as distress. For that reason, we do see scenarios where this is going to be a rolling multi-cycle event, and particularly in some of these medium to high risk markets, there's probably going to be a breakdown where there is a nuanced tier of assets, different stories, different categories. Some pockets of the city might still develop an institutional or near institutional cachet. So we don't say that the entire Sunbelt is off limits. There are a couple of markets that we do suggest deals in. But the broader story is that for the number of people moving, for the capital moving into a lot of these southern latitudes, people are not being adequately compensated for their risk because they're not factoring in how different some of these markets are going to be in the coming cycle.
Yeah, and the only thing I might add to that is to put some granularity on it. Like Owen said, the Sun Belt is not all equal. As a firm and as we do analysis, it is very difficult to consider a state like Florida or Texas in any scenario. So those are places that are definitely off limits to our strategy and to our thesis. There are many other markets in the Sun Belt that can come through that, like Owen said, sort of in a haven criteria, or just because their overall risk readiness is meaningfully different than their surrounding markets.
We've had another question about climate change and farmland investment and what our perspective is on that. So we go forward with great humility on this. We've started with multifamily because the low volatility, the ability to build a portfolio of geographic diversity at speed. I would think of that as a first step in what will probably become a multi-asset class strategy at the firm. The reason I am prevaricating a little bit on farmland investment is because I think we just don't have the data yet to fully understand how the change in some of these regions is going to unfold. So I would recommend people interested in this to consider some of the IPCC and NOAA's national climate assessments. They have fantastic primers on agriculture and all the different ways that, snow melt, precipitation, temperatures, crop yields can all kind of interact together. But given the nature of the amount of change and innovation occurring in agriculture more generally, a lot of different ideas around, some questions with monoculture, stable row crop assets, to what extent are they going to have to deal with their own specific issues? It's something that we consider a later fund stage challenge that we're really excited to tackle, but we probably don't have the data yet.
And I think also on farmland and ag investing generally, there's an ecosystem perspective to it, which is that the farmland is important, the yield is important, in addition is the ecosystem of storage, processing, and taking to market. And that whole chain is actually something that we look at in terms of climate risk, because just looking at the farmland itself doesn't necessarily capture the value chain of what it does.
I have another interesting question on opportunity and our hold periods. Raj,
Yeah.
did you want to take that?
Yeah, this comes to the question of why now a little bit. The question is, what is the timing of the opportunity? Is it long-term hold? No, it's not long-term hold. So our typical assets have business plans in sort of the 3 to 5 year hold period, typically with more of an expectation of an 8-year business plan. These are development or core plus assets that we intend to cycle in and out of. The timing of the opportunity is not necessarily a function of climate risk becoming apparent in the disaster method that Owen described. Often slow onset and other climate risk models, it's a financial risk that starts to come into account, which is starting to happen more and more. So what that means is lenders, insurers, municipalities, the next buyer, and tenants are all taking this into account more and more, which meaningfully changes terminal values of real estate very soon. It's not a multi-decade scenario in which Phoenix reaches or surpasses Death Valley as a hot market. It's along the way that happens. So is it long-term hold? Someone could definitely apply this in long-term hold. There are large ultra-wealthy family offices that do this on a 50-year hold. We are much more looking at the financial implications that get factored in over 3, 5, 7, 10-year holds.
And we could certainly see some scenarios where core investors are the purchasers of a lot of our product.
Yeah.
We've inevitably had a question on ESG. So does our method include or weight ESG-like criteria? And I guess how does ESG fit into what we do? This is a great question. So from each initial assessment of market, submarket, and site risk, all opportunities around in-building resilience and mitigation are then considered. So another way to say that is the typical climate core asset will take every possible step to mitigate emissions, making it eligible for the widest range of ESG criteria investors on exit. But I think it's really crucial to understand physical climate risk is not an implicit pillar of the ESG framework as financial markets presently understand it. I think if it was, far fewer assets would be ESG eligible. So a simple analogy of that would be a net zero building in Miami or downtown LA that we would have specific concerns about from a market perspective, but still many ESG investors would happily purchase. So a climate core building will always be selected with low exposure to all potential location-based climate risk as the primary driver, and then with adaptation as the key ESG category. But we want to stress that this is an ESG eligible investment story, but we are not driven by all ESG principles necessarily. The most important thing for investors to be factoring in at this early stage is what is the location-based risk of your asset.
So 2 good questions. One very simple. Will you be sending out a replay or will we have access to the webinar on your website?
Yes.
Both are true. Another question is your thesis that insurance premiums will rise in climate-exposed markets more than non-exposed markets and therefore erode yield over time? Trying to understand how climate will actually be priced in. Short answer, yes. That's one element of how climate risk gets priced in. Fundamentally, we're talking about terminal value changes. We're talking about repricing in markets that are exposed. How that repricing occurs is erosion of net operating income, whether that comes through insurance premiums that outpace rental growth, whether that comes through lending criteria or the next buyer being subject to different criteria on lending that is more stringent, whether that's through the overall CapEx experience of the asset or OpEx as whether it's utility cost inflation or issues with operating and climate exposure. So yeah, fundamentally how the repricing occurs is the assets are not as attractive.
There's 2 other quick points I'd make on insurance. So it's important to keep in mind that a lot of states have their own localized insurance pools. So Texas and Florida and California, as far as insurance markets go, they don't necessarily take in national exposure. We now, because of regulatory reasons, those specific states have had to deal with the fact that many private insurers have either withdrawn from the market or gone bankrupt, and they are now having to manage through public subsidies a lot of different responses to that. The second thing I'd keep in mind, we haven't touched on it in this webinar, even though it's available in a lot of our other website materials and podcasts we've done. So the backstory to the data set was something I was working on at the Graduate School of Design at Harvard. And as an ancillary project to that research, I happened to have a number of off-the-record calls with large reinsurers. And what I was trying to understand was, because real estate since the beginning of time has put 3% as an annual premium increase in an Excel model or pro forma, I wanted to understand in high exposure markets, was there a more realistic number? So some reinsurers basically said to me, in high exposure markets, you could expect something like 7 to 8% annually. Now, some years that might be 4 to 5%, but some years, as many landlords out there might know, you've had 15 to 20% jumps. Now, if high exposure markets are looking at 7 to 8% annual insurance premium increases in perpetuity or until there is some stabilization, rent is not going to increase at that pace in many places. So you're immediately talking about a terminal value impact there because your NOI is going to be impeded. So that's 2 other things I'd consider about insurance as to how we see the repricing unfolding.
Yeah, and appropriately, someone's just commented in the questions that they recently moved from Massachusetts, where we are right now, to Florida. And while taxes are a fraction of Massachusetts, the insurance is more than twice that of Massachusetts, and one of the insurance companies we deal with just went into receivership. This has been a consistent trend in Florida. There was actually a Wall Street Journal analysis a couple of weeks ago asking the question of, why is insurance in Florida such a volatile and meaningfully more expensive market, even though the key risk, or the one that we all think of most, hurricanes, a major category 4 or 5 hurricane has not hit Florida since 1992. So actually, from a climate experience perspective, Florida has been relatively placid for a couple of decades. What insurers are getting smart about is the overall risk scenario. So insurance companies are the largest consumers of climate risk data, and obviously they look moving forward as opposed to our industry, which often looks backwards. So that will be a common trend in places like Florida, certainly California as well, and Texas. So
from 1960 to the year 2000, America's population increased by 55%. The spatial footprint of America's cities increased by 110%. So what that effectively means is the size of America's cities doubled at the rate of the population. So that just simply means if the same hazard, it's a bit like the Ash Wednesday, New Jersey storm example we gave. If the same hazard hits a location, the path of harm's way, the number of suburbs and build-outs and developments that are in that path is just far greater by virtue of the fact that American cities have spread out so much further. And if you think about a place like Florida, where really many parts of the coastlines, now it's just, large settlements linked together along the water. These are the kind of things that insurers, with their catastrophe modeling and 10,000 simulations, they have to take into account very seriously.
I think we've had a question in the chat. I don't know how we open that.
Yeah. While we do so we've been asked about our backgrounds.
Right.
So very briefly on that, I was a diplomat in the Australian government through my 20s, working on climate and international environment agreements. After business school, worked in a range of real estate family office services, and then came back to the Graduate School of Design to basically work on this question of the repricing of climate and real estate in the built environment. That led me to work under some fantastic faculty. I got to be involved in a very large paper with the CFTC on the implications of climate change for the finance industry. And really the data set, as I began to speak to Raj, started to have commercial implications that I think most of the people we were consulting to at the time didn't fully see. And that's what led us to found Climate Core and actually begin being a long-only participant and a skin-in-the-game allocator. Raj.
Yeah, so I've had a 15-year career in predominantly institutional real estate. Started on the placement consulting side, worked in a private equity real estate shop out of India, and then actually had a fintech platform that connected institutional investors with strategies that met their needs. That was then acquired by a firm where I started focusing more on co-GP investing in Europe and the US, and also looking over some software platforms. So sort of a career across institutional real estate, and focused on the co-GP side on residential and student. We've had a really good question on two parts of the business model that this person's heard: avoiding location-based climate risk and adding value at the asset level through resilience. And those seem like two different things. And I think we can sort of talk about that, particularly if we're holding for short term. I'll say one thing and then hand it over to you.
Yeah,
but
sure.
They are two different things. The vast majority of both owners and investors are focused on carbon mitigation. So it is either improving the asset to increase its sustainability characteristics or ESG scoring, or just making it more sustainable generally. We are focused on that as a secondary thing to location-based climate risk. So how does that factor into short-term holds? I think maybe if you talk about what kind of more the clean tech side of things and what the impact of that is, and then again getting back to what that means for the next buyer in a terminal value situation.
Yeah. I mean, every multifamily building in America is on a journey to asset obsolescence. Like, we can't change that. But the speed at which some buildings are going to accelerate is really meaningful. And in a lot of Class B, Class C, and value add settings, it's going to become economically very difficult to justify the capex required to get some of these buildings up to an energy efficient level. So I very much understand the question, because really the unique selling point of what we're doing is location-based climate risk. And then we are conscious that by having high quality locations, that gives you an opportunity to build the very best products in the market. That is not something we claim to be have a core competency in. We are always going to partner with operators, developers, energy consultants, different people. And to be honest, our data and research arm of the business is based at Greentown Labs, which is the largest climate tech incubator in North America. And it really is striking the number of new technologies that are coming along that can be retrofitted to buildings. We think we do have a first mover advantage by virtue of some of the alliances and partnerships we have with some of those businesses. On the point about the data sources, so absolutely there is free public data on climate risk, and it is becoming increasingly available. We would highly encourage anyone who owns assets, if it's your own personal home, I highly recommend the work of Cal Inman and the team at Climate Check. Go on their website and find out what the risk is of where you live. I would, happily recommend 3 or 4 other commercial data providers out there who are providing some really top quality climate data, and it's getting reported through Chris Lavelle in the New York Times climate section and lots of other areas as it becomes available. What we would want people to keep in mind is that there is an inherently deflationary dimension to data, and we are moving to a point where no one should really expect that there's going to be a huge price attached to climate information. We never wanted to be a climate data firm. We didn't want to be in the business of selling insights. We thought the better way to be involved was to be a member of the big climate long, to be a long-only participant, and to be acquiring buildings in locations, learning about those buildings as time evolved, and crucially evolving the readiness part of our equation. Because I think the thing that we feel we have done to a pretty high quality level relative to many of the other players is looking at readiness as well as climate risk. Readiness can change over time. Climate risk can as well, but effectively what's happening in America is there is a tier of cities that have a first mover advantage. They've taken sustainability and resilience very seriously. They've started to think about permeable surfaces, regreening of trees, tree canopy ratios, stormwater drainage expansion programs, lots of these single individual data points. And as you build and accumulate that story, and then you compare it as well against, simple stuff like the number of houses, people, and building in a 100-year floodplain, you start to see places that are investing preemptively. A plain English way to say all of that is a market like Ann Arbor, Michigan, that we are really bullish on, it's currently only 150,000 people. We believe at some point in the future, that's going to be a 500,000 person market. That's a hard and big idea to get our heads around now, but such is the shock and dislocation that's going to happen in some of the southern latitudes. There is going to be a need for people to move and find jobs and opportunity in other places with lower climate risk.
I think the only other thing I'd add on the public data on particularly flood, heat, and a variety of climate risks, there is no single source of truth on any of those, meaning that each one has its strengths. The methodology and the science behind each is quite different. And most of our work on the data side has been about harmonizing that, about recognizing their strengths, their weaknesses, and attempting to come up with a vision that can encapsulate risk in particular that doesn't overweight something in a way that may be misleading for your overall risk analysis. So there are free places to go, and I think particularly for the homeowner or kind of the common investor, it's a good idea to do that. It is not going to give you a great picture of harmonization of risk over multiple cycles and multiple time periods and across the spectrum of the risks.
I'm conscious of the time. We do have a few more questions, but if it's possible, we want to bring up our contact slide again one last time. We're at the beginning of a journey here, and we highly encourage you to reach out to us. We're available. We're keen to speak. We're happy to talk about some of our investment stories. We have an active pipeline for family offices, emerging manager programs, and other accredited investors. And we're just really grateful for the opportunity to keep telling the story. We're committed to educating the market as we learn. And we really thank everyone's time today and look forward to continuing the conversation in other forums.
Thank you.
Thank you.